Thank you, Ranking Member Toomey. I'll introduce today's witnesses. Ms. Lisa Rice from Toledo, Ohio, is the president and CEO of the National Fair Housing Alliance, one of the nation's leading experts on fair housing and lending policies. Welcome, Ms. Rice. Mark Morial is the president and CEO of the National Urban League. He previously served as mayor of his hometown of New Orleans and is the president of was president of the U.S. Conference of Mayors. President Morial, welcome. Byron Donalds represents Florida's 19th Congressional District before holding office. Representative Donalds worked in the banking, finance, and insurance industries. Congressman Donalds, welcome. Mr. Devin Westhill is the President and General Counsel at the Center for Equal Opportunity. He served as the top civil rights official at the United States Department of Agriculture. Mr. Westhill, welcome. Janai Nelson is the President and Director Counsel at the NAACP Legal Defense and Education Fund. Prior to joining LDF, she was Associate Dean for Faculty Scholarship and Associate Director of the Ronald Brown Center for Civil Rights and Economic Development at St. John's University School of Law. Ms. Nelson, welcome. Ms. Rice, please begin your testimony.
Thank you. Chairman Brown, Ranking Member Toomey, and other distinguished members of the Senate Banking Committee, I am so appreciative of you for inviting me to testify today. The National Fair Housing Alliance is the nation's only national civil rights organization solely dedicated to eliminating all forms of housing and lending discrimination and creating well-resourced, healthy, vibrant, resilient communities. I can empathize with people like Ryan Coogler, who, although being one of the world's most noted and award-winning film directors, was falsely accused of being a bank robber and detained by police when trying to withdraw money from his own bank account. I, too, personally, have experienced differential and humiliating discriminatory treatment when trying to access services from financial institutions. No one should have to experience these types of indignities. Discrimination in financial services is built on our nation's enduring legacy of discriminatory policies and practices. Thousands, literally thousands, of race-based laws like the Indian Removal Act, Jim Crow laws, Black codes, the Homeowners Loan Corporation Act, the National Housing Act, and many other statutes and policies put in place over the last 400 years created inequitable systems like residential segregation. In fact, we're more segregated today than we were 100 years ago because of these discriminatory policies. We have a biased appraisal system, unfair zoning policies, the dual credit market, and biased algorithms that are still in place today, impacting millions of people. In addition, too many people experience unfair treatment and denial of critical financial services and products. The ongoing failure of financial services providers to fairly serve all consumers and communities harms individuals and neighborhoods, stifles innovation, restricts economic progress, generates wealth loss, and makes the U.S. less globally competitive. The cost of discrimination is incalculable. According to research from the Brookings Institution, homeowners in predominantly Black neighborhoods have lost cumulatively $162 billion in wealth due to appraisal bias. Another study found that eliminating bias against communities of color would have resulted in an additional 770,000 Black homeowners and an additional $218 billion in sales and expenditures. But due to biased policies and practices, consumers, our society, and the economy lost out on these benefits. Citigroup estimates that eliminating racial inequities for Black consumers alone would add $5 trillion to the U.S. GDP over a 5-year period. The Fair Access to Financial Services Act fills a critical gap in the fabric of our nation's civil rights and consumer protections and is vital to ensuring people can fully participate in our modern-day economy and that our society can thrive. It covers discriminatory practices not precluded by the Civil Rights Act of 1866, the Fair Housing Act, the Community Reinvestment Act, and the Equal Credit Opportunity Act. A fair, open, and equitable marketplace promotes economic health and wealth for people, communities, and the greater society, solidifying our position as a global leader and making our nation stronger. The nation's history of discrimination, segregation, and financial exclusion reverberate to this day, having massive consequences in the lives of everyday Americans who simply want to use the services that are necessary to fully participate in our economy. Congress has done well to pass hard-earned legislation aimed at preventing this history from being repeated. But more can be done to close loopholes in our civil rights enforcement infrastructure to better protect people of color and other marginalized consumers from discrimination in financial services. The Fair Access to Financial Services Act is an important step in the right direction, and we look forward to working with the committee and members of Congress on this legislation.
Thank you, Ms. Rice. Mr. Morrell, welcome.
First of all, welcome to all of you, particularly my constituent, Mr. Morial, who we're proud to claim as a New Jerseyan, so it's good to see you. I just want to make one comment, and that is that the system as it is isn't working for us. So if we think the system as it is working just fine, then something is wrong. I'm proud to be a co-sponsor of Chairman Brown's Fair Access to Financial Services Act. But in my view, in order to root out discrimination and promote equitable access in the financial system, we need to start at the top with our regulators. Right now, there is a staggering lack of diversity in leadership positions at the institutions that set and enforce the rules of the financial system. As a result, Black and Latino communities lack representation at the table when these critical decisions are being made. So I'd like to ask Ms. Rice, Ms. Nelson, what are the consequences of underrepresentation of minority voices among financial regulators?
Sure, I'm happy to start off there, Senator Menendez, and thank you for the question. So I think it's critical because bringing diverse representation to the table when rules are being set increases the likelihood of creating a more accurate rule. It also increases the likelihood of ensuring that we have the right data brought to bear. I mean, that is one of the reasons that we had the foreclosure and financial crisis in 2008, because we had the wrong data, right? We were being informed by the wrong information in the lead up to the crisis. But it also makes sure that the rules that we craft are accurate, and we're considering how those rules are going to impact all market segments. So it's extremely important.
I want to talk about the issue of discrimination in mortgage lending. The Minneapolis Fed published a paper earlier this year on this topic, and it laid out, we know that in the Twin Cities area, people of color are up to 3 times more likely to be denied a conventional 30-year mortgage than white applicants. The Minneapolis Fed's findings aren't surprising. The pervasiveness of this issue, though, is really jarring. Now, of course, we know that lenders consider multiple factors when reviewing mortgage applications, many of which are race neutral, at least on their face. However, this study specifically focused on low-risk borrowers, and even when controlling for differences in income or credit scores, and even where a home is located, Black and Latino and Asian borrowers continue to be denied at higher rates. Based on the findings of this Minneapolis Fed report. Ms. Rice, can you talk to us about what the consequences are of an economic system that so blatantly excludes families of color from accessing home ownership, and what should we be doing here in Congress to address this specifically?
Yes, thank you so much for the question, and you're absolutely right. Study after study has found disparities in access to credit for borrowers of color. For example, Berkeley researchers have found that Black and Latino consumers who have the same financial profile and the same credit scores as their white comparative borrowers are being charged higher rates when they do access mortgage credit by risk-based pricing systems. And these are algorithmic models that are supposed to take in a number of considerations and factors when pricing risk. But they are pricing borrowers of color at a level that is higher than their commensurate level of risk because of multiple factors that are included in those black box models. Black and Latino consumers are paying $450 million every single year, because they're being charged higher rates than they are supposed to be charged. And there are many, many costs of discrimination in our marketplace. And I'm so glad you asked this question, because I oftentimes like to quote and cite former Federal Reserve Board of Governors Chairman Alan Greenspan, who talked precisely about the cost of discrimination. And he said, and I'm paraphrasing, that discrimination, this is intentional discrimination and unintentional discrimination, erects barriers to the free flow of capital and labor to their most profitable use. He also explained that bias in our markets distorts outputs, creating higher costs of goods. And I must say this, discrimination increases the cost of goods. Eliminating discrimination decreases the cost of goods. It also decreases our national wealth. He talks about how removing non-economic distortions like discrimination increases yields and output, expands our economy, and generates higher returns to both people and physical capital. Discrimination, we know, is one of the major drivers of the racial wealth gap. So let me just cite this. Not only, so when you look at families, when you just look at families, households with children, Black households with children have 1 penny of wealth for every dollar of wealth held by white families. That's a penny on the dollar. Latino families have 8 cents of wealth for every dollar. That's a huge racial wealth gap. And it is causing all kinds of downstream challenges and inequities that we have to face. And we've said over and over again that if we eliminate discrimination, it benefits everyone. It's a win-win. And this is something that we really seriously must address. There are loopholes in the laws, and we have to close those loopholes.
Thank you, Mr. Chairman. I just would like to put into the record a couple of documents related to the earlier discussion Senator Warner and I had in the FBI. It's the letter that Mr. Morial and his colleagues sent. It's a op-ed piece in the Washington Post by Cortland Midloy yesterday, and an op-ed piece by the county executive of Prince George's County that lay out very clearly the income and wealth gaps that have been created in part by the unfair citing of federal agencies in places outside of Prince George's County, Maryland. But on an area that Senator Warner and I agree on, CDFIs. I chair the appropriations subcommittee that funds the Treasury Department CDFI accounts, and we have worked to increase those accounts every year, including, we hope, this year as part of the process. And it was great to work with Senator Warner and others who really pushed hard about a year and a half ago, a little more now, to get that new capital fund and the emergency funds. And I really do think they're a critical part of our infrastructure for getting more capital to lower income communities across the country. And I want to talk also about the issue of banking deserts. Baltimore City has now in many places become one of the worst banking deserts in the country in terms of lack of physical banking locations. And that, of course, both in the city but also other places around the country, means that more people have to go rely on other sources of borrowing, including more and more online financing, some of which provide important protections, but many do not. Many are sort of predatory engines where if you don't read the fine print, you get totally overwhelmed with fees and unfair interest rates. This came up yesterday in a discussion, or the day before, in a discussion here in the Banking and Housing Committee with the FDIC hearing and confirmation hearing for Marty Gruenberg, for example, FDIC. We're pushing hard for the CRA. I think the CRA will help address some of the changes that have taken place over time that undermined the purposes and intent of the CRA. But the reality is, if you look today, fintech loans account for 57% of the unsecured personal loans. Mm-hmm. They're not covered by the FDIC. They're not covered by CRA. And so one overall question is, how do we address that issue? But if you could, Ms. Nelson, speak a little bit about to the impact of the trend we're seeing where you have bank branch closures, so there's no physical presence of the bank. That means more people go online to get their loans, and a lot of these online systems do take advantage of people. Could you just talk about that trend and what we can do about it?
Senator Van Hollen, I know we're over time, but if I can just interject here, because this is an extremely important point. Banks have always, throughout the entire history of the United States of America, disproportionately closed their branches in communities of color as compared to other communities. That has always been the case. It is still the case today. Banks are closing their branches in predominantly high-income, affluent Black census tracts at a higher rate than they are closing their branches in low-income, non-Black census tracts. So it is definitely a problem that we have to fix. When people are forced to go to payday lenders, fringe lenders, it's important to note those entities primarily do not report positive consumer behavior to the credit repositories, increasing the likelihood that their consumers will remain credit invisible and credit unscorable.
Thank you. Thank you all. Thank you, Mr.